Good day, everyone. For today's session, we will continue our discussion about accounting cycle. Last time we discussed about the step number 6. However, step number 6 is not yet complete. We only discussed the format of the worksheet and then the unadjusted trial balance column. So for this session, we will discuss the remaining columns of the worksheet. But before that, of course, we have to discuss first this very important topic, which is about adjusting entry. So this morning, we will discuss steps number 6, which is a continuation of the step number 6 we discussed in the previous lecture up to step number 8. Let us revisit again the accounting cycle. Okay, so far, we already discussed the steps number 1, 2, 3, 4, and 5, and part of step number 6, which is about preparation of worksheet. Okay, as mentioned, we will continue the discussion about preparation of worksheet in today's session, and then we'll follow the preparation of financial statements up to step number 8, which is adjusting journal entries or journalized and posted. And then steps number 9, 10, 11 will be discussed in the next video lecture. Okay, so in summary, out of these 11 steps, okay, we will be able to finish up to step number 8. At this point, let me share with you again the format of the worksheet. Okay, you have here the different columns. You have the account number, account title, the unadjusted trial balance column with debit and credit columns, adjustments column, okay, the same debit and credit columns, the adjusted trial balance, income statement, and balance sheet. Okay, so right after the unadjusted trial balance is the adjustments column. You cannot prepare adjusted trial balance, income statement, and balance sheet without first accomplishing this adjustments column. So it means as bookkeepers or accountants, you have to be knowledgeable in preparing adjusting entries. And that will be our next topic in the next slide. We are now on adjusting entry discussion. Why do we need to make adjusting entries at the end of the accounting period? What are the reasons for adjustments? Okay, so number one reason why we need to adjust accounts is to apportion the mixed accounts into their real and nominal elements. Okay, what are mixed accounts? Mixed accounts are assets or liability accounts which require adjustment at the end of the accounting period because these accounts has a balance sheet component and an income statement component. So therefore, we need to adjust those accounts. And what are those adjusting entries that we need to do at the end of the accounting period which relate to these mixed accounts? Number one is provision for depreciation. Okay, number two, provision for doubtful accounts or bad debts. Of course, when we record receivables in our books, not all receivables can be collected, and normally the entity or business will estimate how much of that amount will be uncollectible. Okay, and number three, adjustments for the expiration of repayments of expenses. Number four is adjustments for the realization of income collected in advance. Okay, we'll have examples for this apportionment of mixed accounts into the real and nominal elements. By the way, if you can still remember, what are real accounts or real elements? Those accounts which are found in your balance sheet accounts are real accounts. And those are assets, liabilities, and owner's equity accounts. How about nominal accounts or nominal elements? Those are accounts or elements found in your income statement. Okay, and what are those? Of course, your revenue and expenses. Next reason, to bring into the accounts unrecorded accrued items. And these accrued items could either be accrual of expenses and accrual of income. Relative to adjusting entry are these two terminologies, deferrals and accruals. Let us define what is a deferral and what is an accrual. Deferral is the postponement of the recognition of an expense already paid but not yet incurred. And this pertains to your prepayments like prepaid supplies, prepaid insurance, prepaid rent, and prepaid advertising, okay, among others, or of revenue already collected but not yet earned. And this pertains to your receipt of cash from your customers, your clients for services to be rendered in the future. And according to the revenue recognition principle, you have to defer the recognition of revenue, okay? Because you cannot record revenue unless you already provided the services, okay? Next is an accrual. It is the recognition of an expense already incurred but not yet paid, or of revenue earned but not yet collected. And for these two terminologies, we'll have examples in our next slide. Let us discuss the first adjusting entry, and this is about provision for depreciation. What is depreciation? This is the portion of the cost of the assets that should be reported as expense in each accounting period. When an entity acquires long-lived assets, okay, or those assets which are to be used for more than 1 year, like buildings, service vehicles, equipments, computers, office furniture and fixtures, etc., the entity, okay, should allocate the cost over its estimated useful life. Why is that so? Because the company expects that these assets will be used in its operations, okay, for a longer period of time, which is beyond 1 year, okay? And normally, the depreciation is being, okay, computed using straight line method. And how do we compute depreciation using the straight line method? We have this formula. Annual depreciation equals cost minus residual value or scrap value over life in years or estimated useful life in years. Okay, let us define each item here in the formula. Okay, let us define what is cost, residual value, life in years, and depreciable cost. Cost is the amount recorded as the value of the asset or the amount an entity paid to acquire the depreciable asset. So, meaning to say, this is the acquisition cost of your asset, and this asset pertains to your depreciable asset. Okay, remember, not all assets are subject to depreciation. Exception to that is the land, because land does not depreciate, it appreciates its value. Okay? What about residual or scrap value? This is the amount that the asset can probably be sold at the end of its estimated useful life after deducting the expected cost of disposal. So assuming you have this machinery and equipment, and at the end of its estimated useful life, which is 10 years, it can still be sold, let's say for 4,000. So that 4,000 is actually the amount that this machinery and equipment can be sold at the end of its estimated useful life. And how about useful life? This is the period of time over which an asset is expected to be used by the enterprise. Okay, another terminology, depreciable cost. This is the cost of long-lived assets or non-current assets less its residual value. Okay, depreciable cost is different from your cost because in depreciable cost, you have to deduct residual value. Okay? Let us have an example for number one adjusting entry, which is depreciation. Assume that repair equipment was bought or purchased for 100,000 on January 1, 2023. The equipment is estimated to be used in the business for 10 years with an estimated residual value of 4,000 after. Okay, let us compute for the annual depreciation. Annual meaning 1 year or yearly depreciation. Okay, we have this formula. Annual depreciation equals cost minus residual value or scrap value divided by life in years. Okay, this 100,000 here is the acquisition cost or the cost, okay? And then this 10 years, your estimated useful life in years, residual value is 4,000. So we will replace the formula. Okay, 100,000 as the cost minus 4,000 as the residual value over 10, which is the estimated life in years. So that will be 96,000 divided by 10 years, and that will give you an annual depreciation of 9,600. How do you record it? Okay, so you have to debit depreciation expense 9,600 and credit accumulated depreciation 9,600. Okay, in some businesses, okay, this accumulated depreciation has additional words after this one. Okay, so the additional words is actually or are actually pertaining to the asset or non-current asset in which this accumulated depreciation pertains. So since this is related to repair equipment, so your credit can also be accumulated depreciation dash repair equipment, okay? Or it's the general, okay, credit title or account title, accumulated depreciation. So either of the two is correct, but you have to consider the account title of the entity. Okay. Next adjusting entry is related to provision for doubtful accounts or bad debts. Okay, as mentioned, bad debts or doubtful accounts, these are the amount of loss the business expects to suffer due to uncollectability of accounts receivable. And usually, the entity estimates the doubtful accounts or bad debts. Okay, and there are four methods for estimating doubtful accounts expense. Number one is fixed percentage of the total sales. Number two, fixed percentage of the total credit sales. Number three, percentage of accounts receivable at the end of the accounting period. And number four, an amount computed through the aging of receivables. For number four, there is a table, okay, reflecting the aging of receivables. And that number four is not included in our discussion in today's session as part of the methods of estimating doubtful accounts expense. So we'll only have number one, number two, and number three. Okay, for number one, whatever is the amount you computed, the same with your number two, whatever is the amount computed will be your debit to your doubtful accounts expense and credit to your allowance for doubtful accounts. Okay, example for number one, assuming that 3% of the total sales, or in the case of the service business, total revenue is uncollectible, and assuming that the total service revenue is, let's say, 1 million. Okay, 3%, for example, is estimated uncollectible accounts. 3% of 1 million, so that is how much? 30,000. And that 30,000 is already your debit to doubtful accounts expense and credit allowance for doubtful accounts. Okay? So the same with your number two. Whatever is the amount computed will be your debit to doubtful accounts expense and credit to your allowance for doubtful accounts. So let's say still 3%, but the basis is on the total credit sales, okay, or total service revenue on credit. And assuming that the amount of service revenue and credit is, let's say, 600,000. Okay, 600,000 times 3%. Okay, how much is that? Okay, that will give you 18,000. Okay, 18,000. So what will be your debit? Debit doubtful accounts expense, 18,000, and credit allowance for doubtful accounts expense. Okay, how about number three? Percentage of accounts receivable at the end of the accounting period. For number three, your resulting amount is the required allowance. In that case, you have to consider the balance of your allowance for doubtful accounts before adjustments. Okay, and let's have an example for number three in the next slide. If the basis of the entity in estimating uncollectible accounts is based on accounts receivable, then the computed amount is the required allowance. So meaning the formula is accounts receivable times percentage of uncollectible equals required allowance or the required allowance for doubtful accounts. Let's have an example for this. Assume an accounts receivable of 3 million and a credit balance in the allowance account of 20,000 before adjustments. Doubtful accounts are estimated to be 3% of accounts receivable. Okay, so since we have the given data, okay, we have here 3 million and the percentage of uncollectible is 3%. Okay, so 3 million times 3%, that is 90,000, and that is your required allowance for doubtful accounts. However, in this method, you have to take note the balance of your allowance account before adjustment. And you also need to take note whether that balance is a credit balance or a debit balance. The allowance account is actually a credit balance. That is the normal balance of allowance account. And the allowance account is actually a contra asset account, meaning this is a deduction from your asset account, which is accounts receivable. Okay, so we have here the computations. Required allowance for doubtful accounts, 3% of 3 million, as mentioned, that is 90,000, less credit balance of allowance before adjustments, that is 20,000. So what will be your doubtful accounts expense? Okay, it will only give you 70,000. Okay, so what will be your journal entry? Doubtful accounts expense, 70,000, and credit allowance for doubtful accounts, 70,000 pesos. Okay, so again, please take note if the method is based on percentage of accounts receivable. The computed amount is the required allowance. You have to take note if there is a balance in the allowance account before adjustment, and take note if that allowance account is a credit balance, which is the normal balance of the account, or a debit balance. Why? Because if the balance of the allowance account is a credit, you will just deduct it from the required allowance to get your doubtful accounts expense. However, if the balance in the allowance is a debit balance, which is not the normal balance of allowance account, then you have to add it. Okay? So if that is the case, assuming that the 20,000 is not a credit balance but a debit balance, so what will you do? As mentioned, you will add 20,000 from 90,000, and that will give you 110,000. So your entry, okay, the amount will change from 70,000, it will be 110,000. Okay, doubtful accounts expense 110,000, and credit allowance for doubtful accounts 110,000. If again the allowance account before adjustment is a debit balance. But in our example, since this is a credit balance, we will deduct this from your required allowance. Why? Because the credit balance is the normal balance of the allowance account, and therefore, you just need to deduct it from the required allowance to get the doubtful accounts expense for the year, which is 70,000 pesos. Next adjusting entry is adjustment for the expiration of prepayments of expenses. And as mentioned earlier, prepayments, so we consider that as deferrals. Okay? This is an expense paid in advance, the benefit from which is spread over a period extending beyond the current accounting period. And when we record prepayments, we have two methods. Okay? We have the asset method and expense method. Your adjusting entries or adjusting entry will depend on the method you use when you record the prepayment at that time of payment. Okay, so let's have an example for this adjusting entry. Okay, next slide. Let's have an example. On August 1, Benji Auto Repair Services paid 48,000 for 12 months rent in advance. So the business paid 48,000, good for 1 year, and that starts August 1. So we have this timeline. So for 2023, it starts August 1 up to December 31, up to January 2024 to July 2024. So that's 12 months. For 2023, how many months had already expired? Okay, so from August to December, or out of 48,000, how many months were already used, okay, by the business? Okay, so from August, September, October, November, December, so that's 5 months. And how much of this 48,000 are still prepaid, meaning the unexpired portion of 48,000. So there's still 7 months left. Okay, So meaning for 2023, if the entity's accounting period is a calendar period and it ends December, so therefore the expense related to rent is from August to December only. So we have 5 months of rent expense. Okay, to record for Benji Auto Repair Services. Okay, so we have to take note of the method used by the entity. It could be asset method or expense method. Okay, so let us revisit what was the entry on August 1. Okay, under the asset method, the entity used literally asset account in recording the payment of rent amounting to 48,000. So therefore, on August 1, debit prepaid rent 48,000 and credit cash 48,000. How about under expense method? Literally, the account title is an expense account. So instead of prepaid rent, it was rent expense, the same amount, 48,000, and the same credit cash, 48,000. How about adjusting entry? Your adjusting entry under asset method and expense method differs. So you have to analyze how much should be adjusted. In terms of asset method, how much should be adjusted to prepaid rent and how much expense should be recorded. Okay, as mentioned, 5 months of this 48,000 should be expense for 2023 because the 7 months remaining are still unused or unexpired. Okay, so therefore, on December 31, using the asset method, there should be a debit to rent expense, which is 20,000, and credit prepaid rent 20,000. Why is that so? Okay, so since the entity used the prepaid rent 48,000, this asset account was overstated. So how much should be deducted from this 48,000 in order to arrive at the correct prepaid rent at the end of December 31, 2023? And that prepaid rent should reflect 7 months unexpired portion. And how much is the 7 months of 48,000? So since 48,000 is for 12 months, so this 48,000 times 7 over 12. So therefore, that should be your ending balance of your prepaid rent. So how much should be your adjustment? Okay, your prepaid rent, 48,000 should be decreased by 20,000. So you credit prepaid rent 20,000 and what is your debit? Your debit should be rent expense equivalent to 20,000 and this 20,000 is your 5 months rent. So by the way, so how much is the monthly rent of Benji? So 48,000 divide 12, so that is 4,000. And since 5 months had already expired, so 4,000 times 5 months, that is 20,000. So credit prepaid rent 20,000. How about under expense method? Okay, under expense method, okay, your adjusting entry should be debit prepaid rent 28,000 and credit rent expense. Why is that so? Your rent expense 48,000 was overstated. Why? Because you only need to record the 5 months equivalent of rent expense and that is how much? That is 20,000 pesos. So therefore the question is how much should be decreased or how much should be your adjusting entry, okay, for this 48,000 in order to arrive at the required rent expense at the end of the year, which is 20,000, okay? So there should be a debit of prepaid rent, debit to prepaid rent 28,000 and credit rent expense 28,000. Okay, let us analyze. Since you have a prepaid rent of 28,000, okay, you reflected the unexpired portion of rent, which is equivalent to 7,000. That is correct. How about your rent expense? You have an initial debit of 48,000 and initial credit of 28,000. That will give you an ending balance of 20,000. And that is correct also. Why? Because your rent expense for 2023, which is 4,000 per month, is equivalent to 20,000. That is 4,000 times 5 months because that starts August 1 to December and that is equivalent to 5 months. So therefore, your rent expense should only be 20,000 at the end of the accounting period. And if you will compare the balances of your rent expense and prepaid rent using asset method and expense method, they should be the same. Okay, prepaid rent asset method, 48,000 less 20,000, 28,000. In expense method, yes, it's also 28,000. How about rent expense? Since you only have one entry for rent expense and that is 20,000, in your expense method, you have 48,000 debit, credit of 28,000, ending balance 20,000. So they are the same. Okay, so and that's the adjusting entry for prepayments using asset method and expense method. Next adjusting entry is adjustment for the realization of income collected in advance. This is still part of the deferral I mentioned earlier. Okay, let us define unearned income is an income collected in advance. And similar to the previous slide, okay, we have also two methods in recording income collected in advance. We have here the liability method and income method. Okay, let us have an example to explain and illustrate these two methods. Okay, assuming that on December 15, Benji Auto Repair Services received 10,000 as an advance payment from customers. During the month of December, services have been rendered to the customer amounting 5,000. Remember, according to the revenue recognition principle, we will only record a credit to income when we earn that income. And when do you say that the income has been earned? Okay, when the services are already provided. Okay, using the liability method. Okay, just like your previous slide, when you record the prepayments, using the asset method and expense method and liability method, since this pertains to income, liability method is the account title used by the entity is a liability account. Okay, in income method, the account title used by the entity is already a revenue or income account. Okay, so let's have December 15. Let's revisit what was the entry on December 15. December 15, when Benji Auto Repair received 10,000, it debited cash 10,000. That's correct. However, in its credit, it credited unearned service revenue. When you put the word unearned before service revenue, that makes your account title a liability account. Okay? So that is unearned service revenue, the same amount, 10,000. Again, unearned service revenue is a liability account. How about income method? Okay, the same debit, 10,000. However, instead of unearned service revenue, it used the service revenue account or service income account, the same amount, 10,000. Okay, and what will be just adjusting entry on December 31? Okay, according to the illustration, out of 10,000 advance payment, 5,000 of this 10,000, okay, the services have been rendered already to the customer. So therefore, your unearned service revenue is already 5,000, down to 5,000, from 10,000 to 5,000. So how will you decrease this unearned service revenue in order to arrive at the correct unearned service revenue on December 31, 2021? So, of course, you have to debit unearned service revenue, 5,000, and record service revenue, 5,000, because this 5,000, Benji Auto Repair already rendered services. So, the revenue is actually 5,000 already. Okay, under income method, you credited 10,000. So, meaning you overstated your revenue account because 10,000, part of which have have been rendered already, but part of which also, the services will be rendered the next year, So therefore, your adjusting entry should be you debit service revenue. You have to decrease your income by 5,000. So the resulting service revenue at the end of the period is 5,000, and your unearned service revenue is also 5,000. So if you will compare the balance of your unearned service revenue and service revenue liability method, income method, they are the same. Okay, unearned service revenue, 10,000 credit minus 5,000 debit of unearned service revenue, that will give you 5,000 credit unearned revenue. Is that the same under income method? Yes. 5,000. How about service revenue? Since there's only one entry, under liability method of service revenue, 5,000. Okay, let's check under income method. Okay, you have initially recorded a credit 10,000 and a debit of 5,000. That will give you also an ending balance of 5,000 credits. So whatever method you use, you arrive at the same balances of your revenue account and your unearned revenue account. Next adjusting entry is related to accrual of expenses. Okay, let's have an example. Okay, December 1, Benji Limhoco borrowed 200,000 from BPI. He issued a promissory note that carried a 12% interest per annum. Okay, what will be your adjusting entry on December 31? Okay, you will just get the proportionate interest, okay, for the month of December. And how will you do that? Okay, the computation is 200,000 times 12% per annum times 1 over 12. Why 1 over 12? Because from December 1 to December 31, which is the end of the accounting period of Benji Limhoco, that is equivalent to 1 month. So 1 over 12, that will give you 2,000 amount of interest. So how do you record accrual of expenses? Okay, you record it as debit interest expense 2,000 and credit interest payable 2,000. Actually, the format of recording accrual of expenses, you have a debit of expense account and then credit payable. Okay, the first word usually changes depending on the nature of accrual. Okay, that's one. So let's say you will accrue salaries. Okay, so you have salaries expense and then credit salaries payable. And let's say the accrual is related to rent. Okay, instead of interest, you'll write rent expense and then credit rent payable. So that is the format when you record accrual of expenses. Okay, next, we have adjustment for accrual of income. Okay, let's have an example. On December 29, Benji Auto Repair Services provided repair services to customer Benjo. The entity intended to charge fees of 12,000 to the customer. As of the end of the month, such services were not yet billed. So in this case, okay, Benji Auto Repair already provided services to Benjo amounting to 12,000. Okay, the thing is, Benji was not able to bill such service to Benjo. So what will be the adjusting entry on December 31? Okay, so you debit accounts receivable 12,000 and service revenue 12,000. Okay, how about if the accrual of income relates to interest? Say, let's say the entity has deposits to a certain bank and the interest earned from that deposit for the year, okay, let's say is 1,000. Okay, so interest income for that deposit is, okay, 1,000. Okay, 1,000. So in that case, you will just replace the word accounts with interest receivable and then your service account, okay, with interest revenue. So the format is you debit receivable and then you credit revenue. You will just replace this first word, okay, depending on the nature of the accrual of income. So let's say the accrual pertains to rent, okay? So you have here debit rent receivable and then credit rent revenue, okay? So that ends our adjusting entry. Okay, thank you so much for watching this video. I hope you learned something and thank you very much once again. If you like this video, you may share this and subscribe to my YouTube channel. Thank you.